The world of trading can be exhilarating. It can also be risky. The 357 rule is your safety net. This simple yet powerful rule helps you manage risk. It promotes disciplined trading. By following the 357 rule, you protect your capital. You also increase your chances of consistent profits. This rule is your roadmap to navigating the markets with confidence. Imagine a world where fear doesn't dictate your trades. The 357 rule empowers you to make calculated decisions. It removes emotional impulses from the equation. This rule is not about avoiding losses altogether. Losses are part of trading. The 357 rule is about minimizing those losses. It's about ensuring your wins outweigh your losses in the long run. Think of the 357 rule as your trading guardian angel. It sits on your shoulder whispering words of caution. It reminds you to stay disciplined when the market tempts you to go all in. This rule is your constant companion in the unpredictable world of trading. This guide will break down the 357 rule into digestible pieces. You'll learn how to implement it effectively. You'll discover the strategic advantages it offers. By the end, you'll be equipped to trade with more confidence and control. The first pillar of the 357 rule is the 3% rule. This rule is all about protecting your capital. It dictates that you should never risk more than 3% of your trading account on a single trade. This limits your downside potential. It prevents one bad trade from wiping out your account. Let's say you have $10,000 in your trading account. The 3% rule means your maximum risk on any single trade is $300. This might seem small, but it's crucial for long-term survival in the market. By limiting your risk, you live to trade another day. Think of it like this. You wouldn't bet your entire life savings on a single hand of poker. The same principle applies to trading. The 3% rule ensures you're never overexposed in a single trade. This rule instills discipline. It forces you to carefully consider each trade. You'll be more selective. You'll focus on trades with higher probability and better risk-reward ratios. The 5% rule is about diversification. It states that your total exposure across all open trades should not exceed 5% of your trading capital. This prevents you from putting all your eggs in one basket. Imagine you invest all your capital in a single stock. What happens if that stock plummets? You face significant losses. Diversification mitigates this risk. The 5% rule encourages you to spread your risk across multiple trades. Let's say you have a $50,000 portfolio. The 5% rule means you shouldn't have more than $2,500 invested in any single asset. This could be a single stock, a commodity, or even an entire sector. Diversification is about balance. It's about not being overly reliant on the performance of a single asset. The 5% rule ensures your portfolio can weather market storms. This rule also encourages exploration. It prompts you to research different markets and trading opportunities. This broadens your trading knowledge and skills. The final piece of the puzzle is the 7% rule. This rule focuses on your risk-reward ratio. It states that your winning trades should yield at least 7% more profit than your losing trades. This ensures your wins outweigh your losses. Let's say you have a $100,000 trading account. You take a trade with a potential profit of $7,000. The 7% rule suggests your maximum loss on this trade should be no more than $1,000. This creates an asymmetrical risk-reward profile. This rule promotes a cut your losses short, let your profits run mentality. It encourages you to hold on to winning trades longer. It also forces you to exit losing trades quickly before they escalate. The 7% rule is about playing the long game. It's about understanding that consistent small losses can be offset by a few big wins. This rule is your key to achieving long-term profitability in the market. Section 5. Strategic Advantages. How the 357 rule elevates your trading. The 357 rule is more than just a set of numbers. It's a strategic framework. It elevates your trading by promoting discipline, risk management, and long-term thinking. Discipline is crucial in trading. The 357 rule instills discipline by setting clear boundaries. It prevents impulsive decisions driven by fear or greed. This leads to more calculated and strategic trading. The rule also emphasizes risk management. By limiting your risk per trade and overall exposure, you protect your capital. This allows you to weather market volatility and stay in the game longer. Long-term thinking is essential for trading success. The 357 rule encourages you to focus on consistent gains over quick profits. This approach leads to sustainable growth and minimizes the impact of emotional trading. Section 6. Implementation made easy. Integrating the 357 rule into your strategy. Integrating the 357 rule into your trading strategy is straightforward. Start by evaluating your current positions. Do they adhere to the rule's guidelines? If not, adjust them accordingly. Next, incorporate the rule into your trading plan. Determine your risk tolerance. Calculate your position sizes based on the 3% and 5% rules. Establish your profit targets and stop-loss levels based on the 7% rule. Remember, the 357 rule is a guideline, not a rigid law. You can adjust it slightly based on your risk appetite and trading style. The key is to stay true to the principles of risk management and disciplined trading. Section 7. Adapting to the market flexibility within the framework. Markets are dynamic, they constantly change. While the 357 rule provides a solid framework, it's essential to adapt to market conditions. In volatile markets, consider tightening your risk limits. You might reduce your position sizes or set tighter stop-loss orders. This helps protect your capital during periods of increased uncertainty. In calmer markets, you might allow for slightly more risk. You could increase your position sizes or set wider stop-loss orders. The key is to strike a balance between managing risk and capitalizing on opportunities. Section 8. Avoiding common pitfalls. Don't let these mistakes derail your success. Even with the best intentions, traders can fall prey to common pitfalls when implementing the 357 rule. Being aware of these mistakes can help you avoid them. One mistake is being too rigid. The 357 rule is a guideline, not a strict set of rules. Don't be afraid to adjust it slightly based on specific trade setups or market conditions. Another pitfall is neglecting to reassess your risk tolerance. As your trading account grows or your market outlook changes, adjust your risk parameters accordingly. Finally, avoid emotional decision-making. Stick to your trading plan and don't let fear or greed dictate your actions. The 357 rule is designed to keep emotions in check. Section 9. Frequently asked questions, addressing your 357 rule queries. Is the 357 rule suitable for all trading styles? While the 357 rule is a valuable risk management tool for most traders, it might not be suitable for all trading styles. High-frequency traders, for example, operate on much smaller profit margins and might not find the 7% rule applicable. Can I adjust the percentages of the 357 rule? Yes, you can adjust the percentages based on your risk tolerance and trading style. However, it's crucial to understand the underlying principles of risk management and maintain a balanced approach. What if I break the rule on a trade? Don't beat yourself up. Analyze the trade, identify the reasons for breaking the rule, and learn from the experience. The key is to use the 357 rule as a learning tool and continuously improve your trading process. Section 10. Mastering the 357 rule. A journey towards consistent trading success. Mastering the 357 rule is not about memorizing numbers, it's about embracing a mindset of discipline, risk management, and long-term thinking. It's about understanding that trading is a marathon, not a sprint. By consistently applying the principles of the 357 rule, you build a solid foundation for trading success. You protect your capital, manage your risk, and increase your chances of consistent profitability. Remember, trading is a journey of continuous learning and improvement. Embrace the 357 rule as your guide, adapt it to your trading style, and never stop refining your approach. Section 11. Beyond the rule, exploring advanced trading tools and resources. The 357 rule is a powerful tool, but it's just one piece of the trading puzzle. As you become more comfortable with the rule, consider exploring advanced trading tools and resources. Technical analysis can help you identify trading opportunities. Fundamental analysis can provide insights into market trends. Risk management software can automate your risk parameters. There are countless resources available to help you become a more informed and successful trader. Don't be afraid to invest in your trading education and explore new tools and techniques. Remember, the 357 rule is your foundation, but the sky's the limit when it comes to expanding your trading knowledge and skills. Embrace the journey and never stop learning.